Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, our webinar title is Financial Ratios, How Savvy Investors Use Them to Assess Stocks. So welcome to this webinar. My name is Shane Chu. I'm the moderator for this session. Now, I'm sure when it comes to analyzing financial statements, most investors will rely on financial ratios for us to do quantitative assessment of the company, for us to look at the liquidity of the company, for us to look at the solvency of the company, for us to assess the return on equities, for us to assess the strength of the balance sheet as well as the profitability. So today, we are going to look into what are the key financial ratios and how we can use them to analyze stocks and also make sense of the number. All right. So before we begin, disclaimer, whatever we share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you are 100% responsible for all your investment risk. Allow me to briefly introduce our speaker today. He is the content producer on kclau.com, where he has written more than 300 articles on kclau.com, and also he is a regular webinar host and presenter on kclau.com. He is also the co-founder of DividendVault, where he transforms newbies into investors who can build dividend portfolios independently via education. So he himself is a dividend investor where he average yields from dividend alone is 2 to 10% per annum. So we are very pleased to have you here, Mr. Ian Tai, right? So good to see you here. Ian, how are you today?
Hello, Shane. Good here, and good evening to all of you guys. And first and foremost, always a pleasure, a privilege of mine to be here in this event organized by Bursa, but of course hosted by yourself, Shane. I mean to say, good
Yeah,
to
it's our
have
pleasure to have you here today. All right.
you.
So I will just stop
So today we're
sharing
gonna
my
have
screen.
fun, yeah.
Yep, and hand it over to you.
And I will share my screen. All right, so let me just share with you my screen. You're looking at my screen, right?
Yes, correct. You can start from slide 4.
Okay, so let's do a. All right, so I'm going to start from here. Okay, so this is where we left off. And guys, just a quick tip before we actually begin. So I need you to prepare me a few things. Number one, a smartphone. Number two, your attention. And number three, if you have any questions along the way, feel free to type in the chat box or no, Q&A box. I'll be happy to actually address them at the end of this presentation. Okay, so why smartphone? Because you're going to do a lot of calculation work today. All right, so I'm going to treat this as an online workshop rather than just me talking. So you are going to be actively participating as a participant. All right. So with that, let's get into it. Okay, so this is actually my own stock portfolio. I won't actually tell you how much, uh, what you call, the size of the portfolio. As you can see over here, there are roughly around 15 or 16 stocks over here. So this is actually something that this is something that you can see on the screen. So these are my top 5 holdings, 1, 2, 3, 4, 5, whereby most of my stocks, if you can see, when it comes to weightage, none of them is actually quite substantial. The highest is actually stock G, where it is actually at 15%. But all these are actually quite trivial. So now, guys, I just want you to do one thing for yourself and for us, just to participate. So type in the chat box. I just want to see, I just want to get to know you a little bit better. How many of you here have a portfolio? Type in the chat box. How many say yes if you already invested and you have already have a portfolio, just type in yes. If let's say you haven't actually started investing, just type in no. All right. So Tong Ji Sen, are these all Malaysian stocks? No. So there are overseas stocks as well. Okay. But there are some which is actually Malaysian. Okay. Besar Malaysian stocks. So most of you guys say yes, just a handful of you says nope. All right, so cool. Thank you so much. Now, I would like you to actually do this. All right, since most of you guys have a stock portfolio already. All right. If you don't have a stock portfolio, never mind. You still can actually participate. I will show you how to actually participate in this online workshop. Okay. So we are going to go through this exercise. Now, I do not know most of you guys, I do not know. All right. We haven't actually met before. I'm just online like right now, doing this sharing session with you guys. So let's do an exercise together. So I do not know you, but right now you have a portfolio, right? What you can do is that you can actually choose a stock that you are now having a capital loss. Okay, just choose any stock. Maybe you have 10 stocks, like for example, here I have about 15 stocks. Maybe one of them I'm actually incurring capital loss. Choose that one. All right. Choose the one that you want to do the exercise today. All right. Just pick one stock and that's it. All right. Eugene Wong says, what if all green, which means say all capital gains? Okay. So if let's say all your portfolio, 10 stocks, 20 stocks, all green, then here's what you do. You just choose any stock that you like to do, you like to participate when it comes to this exercise. Now, for those of you who do not have a stock portfolio, which means say you are super green, you have no stocks in your portfolio, just pick any stock that you like to do this exercise. Okay. Just pick anyone, just randomly pick. All right. So you guys have actually, or some of you guys have actually put in the stocks that you like to actually look into. So we have quite a lot of stocks from very different industries, very different in terms of sizes, very different in terms of business nature. Okay, very good. Oh, Desmond Chong, you say public, okay, you mentioned about public bank. Guys, just one tip. For this exercise, it's best that if you are choosing a bank or insurance company, please choose another stock. All right. Simply because it's not going to be, simply because today the topic is about financial ratios and it's a little bit more elementary. So if you are looking at public bank, you're looking at something which you are looking at the insurance company or bank, that will be actually of a different level. Okay. Choose anything which is not a bank, not an insurance company, and not a REIT. Okay. All right. So keep the stock in mind. And right now we are going to do this. Okay. We're going to do this exercise. So guys, this is actually the framework of today's exercise. So when it comes to financial ratios, why do we assess them as an investor? So I'm actually speaking and presenting in the context of an investor. So what is actually the whole purpose of having these financial ratios? Basically, if you look at it, there are two objectives. So there are two main reasons why we look at financial ratios. The first objective is actually income productivity. Why? Simply because as an investor, we want to accumulate, we want to actually buy, invest, and accumulate stocks that are income productive. So the first ratio, we want to measure the level of income productivity. Okay, so this is the first reason. The second reason is as we are listening to as you are listening to this today, the markets, actually I do not know much about the markets, but I do know that we are investing in times of uncertainty, volatility. There is a lot of ambiguity. We do not know for sure what's going to happen next. Okay. So which means to say the only certain thing that we see today is uncertainty. So that is actually the most certain thing that I can see, which is uncertainty. So because of this, what we want to do is to actually have a stock whereby we want to have a business, a stock whereby it is financially resilient. Financially resilient to actually not just be income productive in good times, but as well as bad times. Good times, bad times, it can survive and thrive. So that is actually why we look into why we look into financial ratios. So this is the second reason, financial resilience. Now, coming back to the objectives, number one is income productivity. So over here, we're going to look at two very basic ratios, okay? So the first one is actually on net profit margin. The second one is return on equity, okay? So these are the two ratios to actually measure the level of income productivity. Now, when it comes to financial resilience, there are three ratios that we're going to look at. The first one is current ratio. The second one is gearing ratio. And the third one is debt to operating cash flow. So that one, I will explain it later. Okay. So are you guys ready? Okay. I see a lot of stocks over here. Okay. So what you can do right now is that you can go to Bursa Malaysia website, go to company announcements. So with that, I'll backtrack a bit. Okay, for those of you, whatever stock that is, so you just type in Bursa Malaysia. Let's say you do not know where you're going. Just click on the Bursa Malaysia. So company announcement, click onto that. Now over here, you can just select whatever stock that you like, okay? Whatever stock that you like, just select that. And then the next thing is that you click onto annual report and then you click search. Okay. And then what you need to do is that you just open up the latest annual report and stand by because we're going to do the exercise right now. Okay. So this is how we are going, this is actually the format for this online workshop. So number one, I'm going to give you the definition for each ratio. Then from there, I'm going to just share with you how you can calculate all these 5 ratios that I talk about from a stock's annual report. Number 3, we're going to do the A/B testing. Number 4, we're going to look at patterns that savvy investors will be looking for. And the 5th one, we are going to talk about the meaning behind all these ratios. That's where the indicators come in. All right. So these are the format, and let's get into it. So the first one we're going to look at is net profit margin. All right. This is the first one, net profit margin. So net profit margin is actually very simple. It is actually shown on the screen, the formula. So here's how you can calculate the net profit margin. So it is done by taking the stocks or the business profit after tax, and then you divide it by revenue and you multiply by 100%. So this is actually the formula. Very simple. Profit after tax, divide by revenue, multiply by 100%. There you go, net profit margin. Okay. So so now you can, so now focus on this screen first, then later you can actually do it on a piece of paper, or you can actually open an Excel sheet where you can actually tabulate all these figures. Okay. So this is actually the A/B testing. Now, focus on the screen right now. Here, I would like you to actually see A Berhad. Okay, A Berhad. So net profit margin is profit after tax, which is 100 over here, divide by revenue, which is 1,000. Okay, 100 divided by 1,000 times 100%. Okay, so because of that, what is the net profit margin for A Berhad? Put it in the chat box. Okay, so this is actually the income statement of A Berhad. All right, so all of you guys are getting 10%. That's correct. Now, I would like you to actually calculate for B Berhad. So B Berhad, all right. So B Berhad, please calculate the net profit margin for B Berhad. So what you do is that you take 150, you divide by 3,000, and then you times 100%. So what are you getting? So B Berhad is 5%. Okay, fantastic. So guys, now you know how to calculate net profit margin of A and B Berhad. Now, you know that A Berhad, okay, it makes about 100, let's say 100 million ringgit. B Berhad is making 150 million ringgit. Okay, so the profit here is higher. But then the net profit margin for A Berhad is higher than B Berhad. So guys, type in the chat box, which of the two companies in terms of net profit margin do you prefer? Is it A Berhad or is it B Berhad? Okay, so all of you guys are typing in A. Fantastic. Okay, very good. Fantastic. So this is actually the answer. And this is actually how you calculate net profit margin. So now, here's what we're going to do. We're going to do the 1-minute quick test on net profit margin. And here, what you need to do is that typically for savvy investors, what we'll do is that we'll backtrack it for 10 years. But here, because it's an online workshop, so I just want you to get the gist of it. So what you do is that you just compile the latest 5 or 6 years lah, okay? When it comes to both profit after tax and revenue. Or you can do this exercise afterwards lah, okay? But then you just do this exercise. Okay, take a company that you have chosen, compile only these two figures, profit after tax, revenue, and then you calculate the net profit margin for each and every single year of that company. From there, all right, you may want to actually answer these questions. Number one, has its revenue increased? Okay, depending on some industries, okay, like for example, there's a decline in revenues in 2020. So if it's due to COVID-19, just depending on the business nature, I think this is actually quite understandable. But put this aside, overall, over the long term, has its revenue increased? Number two, has its profit after tax increased? Number three, in terms of net profit margin, this is actually the pattern that we see. Is it positive? Is it growing or not? Or is it declining? So all these things, answer this, okay? From there, we can actually see certain kind of result. Now, let me just choose maybe one of the stocks that you guys actually put in. I'm going to just randomly pick the easiest one. Okay, fine. So someone put in Magni, all right? So let's do a little bit on Magni. I'm going to choose other stocks, by the way. So this is actually quite random. So I'm going to just type in Magni. Click onto the annual report. So you got a bunch of annual reports here, right? So let's open it up. So this is Magni. Okay, so over here, you can see that certain companies, they have these financial highlights. So what you can do is that you can actually compute, you see, revenues have been given to you. Revenues have been given to you. And so as the profit after tax. So what you can do here is that you can just take all these figures, and you can compute the net profit margin, because now you already know how to do net profit margin, the calculation, you know how to do that. Then from there, you find the pattern. Okay. From here, what we can see is that there is a little bit of pattern that we see. Because if you look at these figures, profit after tax have been growing, but here there's a slight dip in terms of profit after tax. So as an investor, now the question is, if you are already a shareholder of this company, the question that you may want to ask is this: why does the profit actually drop to this level, 90 to $100 million level, as compared to last time? It could actually generate 127 million ringgit. So you want to find out why. You have to investigate, okay? So this is actually something that we will be doing, okay? So this is actually the first ratio, which is net profit margin, okay? So clear? with that, let me move on to the next one. Okay. Before we move on to the next ratio, so all these questions here, right, that you ask, revenue increase, profit after tax increase, net profit margin, is it positive? Is it increasing or not? So if let's say you find that most of the answers here are yes, then I would say that the stock that you now own is actually income productive. But then the thing is that if let's say some of you guys say, hey, some of the stocks that I own, they are not they are what do you call? Their their profit after tax is there's no profit after tax. It's all loss after tax. Then of course, then you know that your stock at this point in time is not income productive. Okay, so that is actually how you assess things in terms of income productivity. And that is actually for ratio number 1, net profit margin. All right. So if you're not too clear, just type in the chat box. No, type in the Q&A box so that I can track your questions clearly. All right. So with that, let's move on to the next one, which is return on equity. So now focus on the screen and let's get into it. Return on equity, or ROE. So here's how we calculate return on equity. Number 1, we look at the earnings of the company. All right. Sometimes it is profit after tax, but sometimes it is a little bit lesser than profit after tax. Okay. So we take the company's earnings, we divide it by the company's shareholders' equity, multiply by 100%, and there you go. That is return on equity. Now, how do we calculate return on equity? Very simple. So we're going to do the A/B testing again. So we have A Berhad, we have B Berhad. Now, just now, A Berhad, we have the income statement, which is over here. Okay. So we have revenue, profit after tax. Revenue, profit after tax. Okay. All this is actually from the income statement. Now, this one over here is from the balance sheet. Okay. This is just an excerpt from the balance sheet. So for A Berhad, when it comes to shareholders' equity, 1,000, that's the figure, 1,000. For shareholder B, for B Berhad, the shareholders' equity is 3,000. Okay, so how do we calculate return on equity? Very simple. First, we take the earnings of the company. So for A Berhad's case, the profit after tax or the earnings is 100. And then you divide it by 1,000. And that is actually the shareholders' equity times 100%. And I believe you should get 10%. All right. So that's how you actually get 10%. Next, you look at B Berhad. B Berhad, can you actually type in the chat box, what is the return on equity for B Berhad? So B Berhad, if you want to calculate the return on equity, it is 150 divided by 3,000. Earnings divided by equity times 100%. And you should be getting 5%. All right. So that is actually the case. All right. So there's a slight typo over here. So let me just change this. Fantastic. All right, still loading. All right, so that is actually the case. Oh, looks like got ahead of myself. Let me just change the figures. Okay, so I've double checked already. So this is actually the answer over here. So we have A Berhad, 100 divided by 1,000 times 100% equals to 10%. B Berhad, 150, but despite making more, okay, in terms of quantity of profits, but it takes more equity in order to make this. So therefore, the return on equity is just 5%. So between the two, which of the two companies do you prefer? Is it A Berhad or is it B Berhad in terms of return on equity? I guess this is actually quite apparent, simply because for investors, right, we want companies that have better or higher return on equity. So therefore, the ones that have higher return on equity will definitely be preferred by investors. Okay, so investors want positive net profit margin and return on equity. And not only that, the one that commands the higher net profit margin and as well as return on equity are preferred as compared to the ones with a lower net profit margin and return on equity, right? Okay. So now we're going to do the 1 minute quick test. So it's actually quite simple. All we need to do now is to actually tabulate this figure and calculate the return on equity. So back to this example. So this is actually for Magni. Now I'm gonna just pick another. Now I'm just gonna pick another company just for fun. Let's see what I can actually get. Let's see here. Let's see any. Okay lah. It's been a long time. I last actually see Duo Pharma Biotech. Okay, so let's just you know, for the sake of it lah, for the sake of fun, let's just see how's the company doing. All right. So just click onto the latest annual report, like what I'm doing right now. So is it part 1 or part 2? Usually, if I just want the financial figures, I'll click on the later part, which is part 2. Just waiting for it to download. And then let's just see whether or not this company, it fits or not. But of course, whether or not it fits, you have to actually download this, and this in order to find out lah. Okay. But anyway, let's just check for the past 2 years what happens. Okay. Okay. So first and foremost, we are at the company's income statement. So this is actually the figure that you need to calculate net profit margin. So it's profit for the year divided by revenue. That is actually how you get net profit margin. Next thing is, when it comes to return on equity, you take this figure, you go to the balance sheet, or it is also known as statements of financial position. See this equity? Equity attributable to owners of the company. Okay. So this is actually the figure that you need to compile. And you compile it here like this. And then from there, you calculate the return on equity. Okay. And then you do it for 10 years. Now over here, let's do it for 1 year. Okay. Let's just do it for 1 year. And then you do the rest, the remaining 9 years you do. Okay. So let's do it for just 1 year. Guys, type in the chat box. So this is for Duo Pharma. I'm just selecting the stock. Random lah. It's not planned anyway. So this is actually the latest one. So I'm looking at this report with you right now. Calculate the net profit margin for this company for 2023. So for 2023, let's calculate the net profit margin. So we take 52645 divide by 727. Okay. So guys, how many of you are getting? Okay, so we have Albert. Albert is getting 7.5%. How many of you are getting 7.5%? Or how many of you are getting 7.47%? Type in the chat box. Okay. So Gan Swat Kim, 4.47%. Okay, fantastic. Cheryl Tang, 7.47%. That is actually correct. Very good. To Sing Hui as well. All right, that is very good. Now I'm going to go on to return on equity. Okay, so return on equity, what do you need to do? You have to take profit for the year, which is 52645. Okay, type in 52645, and then you divide by the shareholders' equity, which is 687,123. divide by 687,123. Okay. And then type in the chat box. What is the return on equity for this stock? Okay. So the return on equity is 7.66%. Okay, very good. So guys, now you know how to calculate all these things already. It's time for you to backtrack it. Okay. It's time for you to backtrack it and see a pattern. Because now you only have 1 year. So you backtrack it for 10 years, then only we can see a pattern. All right. So that is actually the story. That is actually the case. From this 10-year figure, after you have collected 10 years of this kind of thing, then you can see, oh, is this company consistent or not? Is this company, despite all that has happened in the market, can it actually maintain positive, growing, increasing net profit margin or return on equity? The ones that do, please keep it. The ones that cannot do so, then you know lah, all right? Why? Then you have to ask yourself, why you buy this? Why do you actually buy this stock? And if you happen to not buy this stock and you found this kind of stock that doesn't have net profit margin, doesn't have return on equity, then the question is, why are you buying this stock, right? So this is actually how you assess the profitability of stock. All right. So with that, let's go back to the slide. All right. So it's actually the same thing. So if the answer is yes for everything, all the questions asked, then your stock is income productive. If no, then you have to revisit why are you buying into that stock. Okay. Now, next thing, current ratio. Okay, so current ratio. So just now we have actually done part one, whereby it's all about income productivity. That one we measure it based on net profit margin and as well as return on equity. Next, we're going to do financial resilience, which means to say whether or not it has a strong balance sheet to actually survive and thrive despite all uncertainties. So this is actually a very defensive move because you want a stock or you want a business that is actually very solid when it comes to its finances. Okay. So sometimes in the stock market, it's not so much about the returns or how much returns am I going to get. Sometimes it's about whether or not it can sustain or not, whether or not it's going to be there for the long term. So how do we do that? We actually measure its financial resilience. The first one is to actually measure it based on current ratio. So which is our third ratio for today. So how do we actually calculate current ratio? So I will actually change the formula a little bit. I'm going to just remove this. All right. And I'm going to explain why I'm going to remove that times 100% because we don't do times 100% for current ratio. So current ratio is actually very simple. It is to take the company's current assets, divide it by current liability. There, you will get your current ratio. So guys, type in the chat box. All right. Where on earth do you get a stock's current asset and current liability? Where do you find this information? Type in the chat box if you know. All right. See whether or not you are well versed with this. Okay, so Albert says BS. It stands for balance sheet. Correct. All right. So it's a balance sheet. Statement of financial position. Yes, that is actually correct. That is actually where you get this kind of information. All right. So very good. Now, for those of you, we're going to do the A/B testing again. So look at the screen. We have A Berhad, B Berhad. So from here, let's start with A Berhad. This is current assets, 1,005. Now, look at all the composition of the current asset. So what exactly is current asset? So current asset of a company is actually things that are either cash or you can actually convert it into cash within 12 months. So what can you actually convert it? What kind of stuff can you actually convert it, all right, into cash within 12 months? So the first one is that if let's say you're operating a retail or a grocery store, so all the stock that you see inside all the inventories that you see inside the retail outlet, that is actually something that you can convert it into cash, all right? And that one, Of course, once you sell the stock, then it becomes cash lah. Okay, so that is actually part of current asset. All right. How about trades receivable? What is trades receivable? Trades receivable is something like this. Let's say, for example, I'm a businessman and you are my customer. So what happened is that I sell you something. You already obtained the goods, but then I haven't received the money. So it's like hutang lah, you know. So I issue you the invoice and then you promise to pay me back in 60 days time. So that is a form of trade receivable, which is a form of hutang lah, short-term hutang by your customer. Okay, so that's current asset. Current liabilities will be the opposite lah. So it's like the bills that you need to pay within 12 months. So how do you actually measure? So what is the meaning behind current ratio? So for Aberhard, some of you already got it right. All right, Zaidan got it right. Like for example, current asset divided by current liability, 1,005 divided by 500, that's 3 times, right? So what does 3 times means? It's actually, so for us, it's actually measured in years. Okay. I'm going to bring, this is actually very corporate, but I'm going to bring it down to the personal level. So in the personal level, right, it's like this. Let's assume that in order to survive, my living costs, my living expenses, my mortgage, my car loan, my makan, my minum, my entertainment, all right, my how do I say, my parental allowances and all this kind of stuff. You lump it up, every year I need to spend 100,000. So if let's say my current asset, let's say it's just only cash, I only have 100,000, right? I have 100,000 in my bank account and my annual expenses is 100,000, which means to say, my current asset 100,000 divided by my, let's say, current liability is 100,000. So therefore, my 100,000 can last me for 1 year, 1 tahun. So for Aberhard, 3 means 3 tahun, 3 years. Okay, it means to say it has enough resources to last him for 3 years. That is actually what it means. So for Aberhard, if you look at it, current asset 1,008, current liability 3,006. So which means to say my annual expenses is like 100,000, but I only have 50,000 in my bank account. So which means to say my 50,000 can last me for half a year, 6 months. That is actually what it means. Okay. So very long-winded, but then the whole gist of it, that is actually the meaning of current ratio. Okay. So which means to say, we want to actually find out whether or not the company, right, is financially steady enough, has enough resources to actually meet its short-term obligations. Okay. So I guess some of you guys have already calculated. Current ratio for Aberhard is 3 years. Current ratio for Aberhard is half a year or 6 months. Now, look at this Aberhard and Aberhard closely. As a dividend investor, type in the chat box, which of these two companies, right? Which of these two companies do you think can actually pay out, will be a better paymaster when it comes to dividends? Which of the two companies can pay out dividends better? All right, so a lot of you actually says Aberhard, Aberhard, Aberhard. Correct. It is exactly that. It's actually Aberhard. Why? Okay, so I'm going to share with you some bonus with you guys, just to share with you my pandangan lah, my viewpoint as to why I say why Aberhard. It's not just about current ratio, you know. You look at the current asset. All right, you see here cash. Most of the current asset consists of cash. So this one, if it chooses to use cash to pay out dividends to investors, it can do so. Now, on the flip side, what if you're a growth investor? What if you are a growth investor, and growth investor is a type of value investing? Growth investors are value investors whereby they want the company to not just have cash, but they know how to use the cash to invest so that the company can make even more money in the future. That's called growth investing. So which of these two companies can actually invest for growth? Again, it is Aberhard. So you need cash to pay out dividends. You need cash to grow. So therefore, that is actually why we measure current ratio. All right. We want to make sure that the company has enough current ratio to not just pay dividends, but also have money set aside for growth. Okay. What about B berhad? B berhad, you see, cash is like this. Most of the money is actually stuck. It's either in the stock, the inventories, or trade receivable. So because of this, right, how do you actually expect B berhad to pay out dividends to shareholders? That's number one. Number two, how do you expect the company to actually where on earth does it actually get the funding to grow its business in the future? A bit difficult, lor, right? So therefore, that's why we will choose A berhad over B berhad. Okay, so there's a reason for it. Now, do the 1 minute quick test. You may want to actually compile this data, current asset and current liability, and from there you see the pattern. So the questions that you may want to ask is this: does the current asset, is it more than one or is it below one? That's number one. And number two, you want to actually also know the proportion of cash inside its current assets. Okay, so that is actually very important. So the more cash, the better. All right. Now let me just pick a stock that you guys type in the chat box. Okay. Let's see over here. Let's see over here. Okay lah. I have no idea what is this Clasita thing. All right, let's just see Clasita lah. Okay, for fun. All right, for fun, so that you know how to. You can see that all these things, right? It is actually highly applicable for many stocks. Okay, so we are at Clasita. I've never come across this company, but anyway, let's see. Oh, so it has changed name from Kaylee Holdings to Clasita. Okay lah, let's tengok lah. Let's open the annual report and let's just see how it goes lah. Okay. Financial statement is always at the middle part of the annual report. Okay. So this is the statement of financial position. So we can see that it has this amount of current assets, 166 million. Okay, so 166 million. Now let's see its current liabilities. It's about 85.7 million. Okay, so what you can do right now is that you can take, if you want to calculate the current ratio for Clasita, what you do is that you take this figure, 166,204,816, you divide it by 85,718,553. All right, so how many of you? So if you do that, you will get a stock which will get a current ratio of 1.94, right? So which means it has enough current assets to actually last him for almost 2 years. Okay, so that is actually what it means lah. Okay, so that is actually what it means. But of course, if you want to actually get a much more clearer picture, I don't take 1 year, I always take 10 years and see and follow the whole story. Okay. But since we are at Clasita, I just want to know, how does it look like when it comes to profitability lah? So which means we are going back to ratio 1 and ratio 2 just to see. Okay, so we are here at income statement. So technically speaking, you see bracket over here? Bracket means lose money, means it has incurred a loss. That's what it means. That's why it's a bracket. Okay. So you take this, divide by this, your net profit margin will be negative. That's number one, right? And of course, by default, since you already have a negative of loss, you have a negative in terms of profitability, loss after tax. Now you take this loss attributable out of this loss, other people out of this loss, your share is actually this 9.1 million. You take this 9.1 million, you divide by the equity over here, 105.2, you will get a negative return on equity. All right. So, which means to say, in terms of income productivity, not income productive, all right, because it has a negative, it is negative in terms of both the net profit margin and return on equity. So that is actually what it means, law. Okay, so that's why we calculate financial ratios in order to identify all this kind of stuff, right? But coming back to current ratio, it definitely has enough resources to stay on for the time being lah. Okay, so that is actually the case for class theta. Okay, so with that, let's move on to the fourth ratio. Gearing ratio. Okay, so the fourth and the fifth ratio, we're going to do something which is related to debt. Okay, so let's get into it. Gearing ratio. Now, gearing ratio, what we can do is this. So this is the typical formula where we're going to take the company's non-current liabilities. So what are non-current liabilities? Non-current liabilities are something like this. Let's say you have a car loan, 9 years car loan. So the debt that you will be repaying for the next 12 months, that is under current liability because you're going to settle it in 12 months. The other balance, anything beyond 12 months, all these are non-current liabilities. Why? Because you're going to settle them after 12 months. So non-current liabilities, you divide by shareholders' equity times 100%, and there you go. That is actually gearing ratio. Okay. So what happened is that there are many ways, by the way, before I continue, just want to let you know that there are multiple ways to actually calculate gearing ratio. Okay. It doesn't matter what formula you use, but what is important here is to find out the pattern. Okay. Because at the end of the day, a gearing ratio of, let's say, X%, it may not be that meaningful if it's not accompanied by multiple years of this kind of finding. Okay, so whatever formula you use, just make sure you find just make sure that you can find yourself an identifiable pattern. So in this case, I'm just going to go old school, and I'm going to just share with you how you can calculate this very quickly. Just one of the many formulas that exists, okay, when it comes to calculating gearing ratio. So what you do is that you take non-current liability, which is for A Berhad is 100. You divide by shareholders' equity, which is 1,000. 100 divided by 1,000 times 100%. So you should get 10% in terms of gearing ratio. Okay. So that's for A Berhad. Now let's look at B Berhad. So B Berhad, we have non-current liabilities 4,500. Shareholders' equity 3,000. So guys, type in the chat box, what kind of percentage are you going to get when it comes to gearing ratio for B Berhad? So you take 4,500 divided by 3,000 times 100%. So Gan Kok Cheng, 150%, correct. Gan Swat Kim, 150%, correct. Exactly. All right. So guys, you should be getting 150%. Now, comparatively, if you compare A Berhad and B Berhad, see this gearing ratio, one is 10%, one is 150%. Which of the two do you think is more conservative when it comes to debt? Is it A Berhad or is it B Berhad? Definitely, I would say A lah. All right, A Berhad is actually more conservative. Okay, so for B Berhad, whether it's good times or bad times, such level of gearing, when you have so much borrowings, right? When you have such level of borrowings, no matter what situation, you have to pay interest costs. You got hutang, you bayar the faedah. Now, the question is this. Sometimes interest rate go up and sometimes interest rate come down. Okay. So let's say interest rate go up. Which of the two company will be more impacted in terms of profitability? Is it A Berhad or is it B Berhad? Type in the chat box. Which one will kena? Oh, ayo, OPR naik. How? Of course, B Berhad is gonna be impacted lah. Okay. And this is actually especially if the long-term borrowings, most of the borrowings are based on floating rate, then of course B Berhad will kena lah. Okay. So that is actually the logic behind it. So how do you actually overcome this interest rate hike up, hike down? How do you actually counter this? It's actually quite simple, actually. Number one, if you don't really want to have that kind of headache, you don't want to like, how are this on that, then you just find stocks whereby the gearing ratio is relatively low. Then eventually, then you kind of like eliminate this kind of issue, just like that, lor. Okay, simply because whether or not interest rate hike or whether or not interest rate actually goes down, it doesn't impact you that much lah, because your gearing ratio is not that much in the first place. Okay, so that is actually what gearing ratio can do. So you can actually do the 1 minute quick test to actually see the gearing ratio of your company. Okay, so now I'm gonna just go up. I'm gonna just see what other companies that I can actually find. Let's find a good company. Okay lah, we have Anyco. Anyco says Ncom. Okay lah, what's Any? So Mcom, let's go into Mcom and tengok lah. Let's see what's Mcom all about. Yeah, quite a number of Mcom over here. Mcom Logistic, Mcom Nilex. Okay lah, let's just do Nilex lah for the time being. Not too sure which of the two. Maybe this is what Any is referring to lah. Okay, Mcom Nilex. Let's just download the annual report and let's see what we can find from this set of figures lah. Okay, so this is Ncom. So we have 222 pages right in smack in the middle. And let's take a look. All right. So in terms of non-current liability, take this. You can divide by this or this, whichever you prefer. Okay. So let's say you take this and let's divide by this for the time being. All right. You should get roughly 102,425 divided by total equity 523,931. Then you should get a gearing ratio of 19.5%. Okay. So that is actually what I've gathered for Ncom. Okay, the gearing ratio is about 19.55%. Actually, anything below 30%, below 50%, that one is actually quite okay lah. All right, which means to say the company is not that bad lah when it comes to gearing. All right. So if you happen to choose this stock and you kind of like have capital loss on this stock, right? Maybe gearing is not the main issue. Maybe it could be other factors. So this is where you actually come in and say, okay, let's start off with the profit margin, maybe the return on equity, and then you calculate the current ratio, and then you calculate the gearing ratio. Then from there, you find out clues lah. Actually, from these 4 ratios alone, you can actually find out a lot of clues, a lot of things about the company already, if you have a 10-year data for this kind of stuff lah. And the better thing to do is not to actually use a software or whatsoever. It's actually to go through the accounts, which are all free. It's all there in Bursa Malaysia website, and then you just do the simple calculation. From there you kind of like know already lah. All right, whether or not you are interested or not so interested to get into the stock. Okay, so that is actually what this website is all about this whole Besar Malaysia website, the company announcements. This is actually the purpose for using it lah. At least that's how I look at it as an investor. Okay, so if you actually find a company whereby the gearing ratio is consistently below 50%, typically you can say that the company is quite conservative in using debt. Otherwise, if let's say you have a company that is actually quite high in terms of gearing ratio, does that mean that it is very aggressive in using debt? That one, we put on hold first because there is another ratio that we need to calculate, and that is ratio number 5. All right, which we are going to do it right now. Ratio number 5, we are going to talk about debt to operating cash flow ratio. Okay, think of it this way. The logic is something like this. Okay, so let's say, for example, I have $1 million in debt. Does that mean, whoa, wow, you have $1 million in debt? That's a lot, eh? But what if I tell you that my monthly installment for that debt, it's, let's say, for example, 5,000 ringgit. Okay, let's say my monthly installment for my $1 million in debt is 5,000 ringgit, and every month I can bring in 50,000. Every month I make 50,000 ringgit. So my income is 50,000. My debt installment is 5,000. Now, for those of you who are investing in properties, you kind of like gather, hey, isn't this sound like debt service ratio? Yes, it is the same concept. So which means to say we are comparing its debt, the total amount of debt versus its what we are measuring is actually the debt repayment capability of the stock. Okay, so that is actually the whole principle, the whole logic behind this debt to operating cash flow ratio. It's actually the same mentality or the same wavelength or concept. So let's get into it. We are at the final ratio. So now here's the thing. So let's say, for example, so we have just now I mentioned about 1 million, right? So let's say 1 million is my non-current liability, and my operating cash flow, I make 50,000 every single month. So 1 year, I'll be making about 600,000. Every year I make 600,000. My total debt is 1 million. How long do you think I can pay it off if I want to? I believe I can actually, if I'm making 50,000 every month, 600,000 every year, and my total debt is 1 million, I think I can pay it off within 2 years lah. All right, more or less 1 or 2 years, I can actually selesaikan the hutang just like that, right? I can just, if I want to lah. Okay. Now, however, it is actually very different if I have $1 million in debt and I don't have income, or I don't have cash coming in. Then this one is what Hokkien people say, jialat lah. Oh, you have a lot of debt, but then no income coming in, no cash coming in. Then macam mana? How do we do? Jialat lah. Then habis lah, you know? So which means to say, whatever debt the company has, even the gearing ratio is high, as long as the operating cash flow can support it, then it still makes sense. All right. But if let's say the company cannot bring in or does not bring in consistent cash flow, then it's actually not too good already lah. All right. So that is actually the whole idea behind this ratio. Okay. So now we do the A/B testing. So we have A, we have B. A, we have non-current liability. All right. So here is 100. Operating cash flow 100. So which means to say within 1 year it can selesaikan the hutang. So that is what it means. For B Berhad, let's calculate the debt to operating cash flow. So it has this amount of debt, 4,500. That's the debt. All right. Operating cash flow 150. If the company chooses to actually pay off all his non-current liability, how long does it take? So Kok Cheng, Gan Kok Cheng says 30 years. Correct. It is like 30 years. Wow, it's like damn long. All right. It's Ahmad Azhar. Ahmad Amza Sohaimi. Yes, 30 years. It's like, wow, when will it actually pay off? Selesai, bereskan all the hutang. 30 years leh. Wow, this is like super long. Okay. So which means to say for this ratio, the lower the amount of years, the better. Okay. And now it's time for us to do the back testing. Okay. So let's do the back testing. Okay. So all right, we are about to go into Q&A. All right. So I'm gonna just look at the final stock lah. Okay lah. This time I pick. Should I pick or okay lah? Let's pick one lah that I think. Let's see what I can think of right now. What are the stocks? Okay lah. Let's try Heineken lah. Let's try Heineken. I think it's one of those type of company lah. Okay, but I'm not too sure. So let's just work it out with me. Yeah. So this is Heineken. Okay. Actually, it's not quite because you see here the gearing ratio is actually quite relatively low. Here's 40 million. Here's 459 million. So I don't think the gearing ratio is that high. But if you want to see its operating cash flow is here. So it make about $584 million in operating cash flow. At least that's the case for 2023. 584 million in operating cash flow, and how much non-current liability it has? 40 million. So I guess this one, the company, debt is actually not an issue. Let me find you another company. Okay lah, I think maybe a telco lah. Let's see Celcom. It's been a long while I last look at this annual report. Let's just play along. Then we will end this session already. All right, let's see. Okay, all right. So this is actually a classic example. Let's see whether it works. Okay, so non-current liability. You see here, 12.5 billion, right? 12.5 billion ringgit. That is actually non-current liability. Now, total equity is 16.5 billion. So what is the gearing ratio for this? Now, we take non-current liability, this figure, 12546,418. You divide it by total equity, which is 16458,766. How many of you are getting? Type in the chat box. What are you getting? What kind of figures are you getting? All right. So is it so for me, I'm actually getting 76%. How many of you are getting 76%? Type in the chat box. So Huang says yes. T Heng Guan 76.22 or 23. Yes, correct. So fair enough. So according to the slides, according to this is actually above 50%, right? So if it's above 50%, so there's a caveat. Now we have to look at ratio number 5, which is debt to operating cash flow ratio. So what we do now is that we want to see whether the company can actually pay off this. How long can it actually pay off this debt? And to measure this, let's look at operating cash flow, which is at the statement of cash flow, right? So here, we have to scroll down to the last line over here. Bam. Can you see that the net cash flow from operating activities here is about 5 billion? Usually we don't take 1 year lah. Usually we see the pattern for the past 10 years just to see whether or not the company is consistently generating operating cash flow from its business activities. which in the case for Celcom DG, it's always about telco lah, all right? So does it generate this amount, how many billions does it generate? So let's assume that this is a company that can actually generate $5 billion in operating cash flow every single year. So 5 billion, and then the debt is actually 12. So you take 12.5 divided by 5 billion, you should get a figure of 2.5 years. All right. So if let's say the figure is actually anything below 5 years, I think that one, I mean to say, I believe that in terms of debt service ratio, it is quite okay, still okay. However, if let's say this company, the cash flow is not so positive, the cash flow is very unpredictable, then it's another story. Okay. Because at the end of the day, what you want in a company is a company that is income productive. All right. It is cash flow generative, and the balance sheet strength must be there. All right. So if you have this three in mind, usually the fundamentals of the company shouldn't be that bad lah. So that is actually number one. And just now, if you're doing the exercise, you happen to choose a company whereby you are actually going through capital losses. And if let's say the company that you choose is memang very good in terms of income production, in terms of balance sheet strength, then maybe your problem is valuation. That's the first one. Number two is that if you happen to choose a stock and then you find yourself, there's capital loss. That's simply because there's no net profit margin. There's no return on equity. The balance sheet, there's no current ratio. Then you know the gearing ratio is very high, and so on and so forth. Then you know, okay, fundamentally speaking, your stock isn't the best. Okay, that could actually explain why your what do you call your stock selection process not quite there, not quite good. Okay. So with that, let's put all these things together and we can go for Q&A. So we have the 5 ratios: net profit margin, net profit margin, return on equity, current ratio, gearing ratio, debt to OCF. So these are the metrics that you may want to measure. So if the fundamentals of the companies that you choose is strong, but then you incur capital loss, valuation could be the problem. But if let's say the fundamental is big, then you know you actually did not do value investing lah. You actually, I do not know lah. Then you have to revisit why you buy the stock in the first place. So that is actually the case here. All right. So with that, thank you so much. And I'm going to just pass the control back to Shane.
All right, thank you so much, Ian, for sharing with us, the different kind of financial ratios and how do we interpret them. All right, so if you have any questions to ask our speaker today, Ian, please write your question in Q&A box, okay? Not the chat box, write them at the Q&A box.
All right.
Okay, I've seen a couple of questions right now. Please write your questions in full sentences because there are some questions after I read them, I don't really understand what you mean. All right, write your questions in full sentences. So when it comes to calculating ratios in relations to this equity portion, the shareholders' equity, right? So do we use the shareholders' equity that's stated there, or we need to exclude the minority interest? That's a question by Vincent.
Okay. So this one need a little bit of explanation because okay lah. Since like that means explain more. So all right. So let's get into it lah. Okay. How should I start? Okay, maybe I'll just add one more
Maybe you
slide.
can start by explaining what is minority interest.
Yeah, that's the tough part to actually explain. So let me just see whether I can do this or not over here. Okay. Let's see. So supposedly lah, okay. we have A Berhad. So me and Shane, both of us. So without me and Shane lah, let's say I'm the only one. I own let's say there's A Berhad. I'm the shareholder of A Berhad. A Berhad has two subsidiaries, A1 Berhad, A2 Berhad. A Berhad owns 100% of A1 Berhad. A2 Berhad owns about 80%. Okay, A Berhad owns 80% of A2 Berhad. Okay, for A1 Berhad, it makes $10 million in profit. A2 Berhad makes also $10 million in profit. So the question is, how do we actually present this in a balance sheet, in the income statement? Okay, very simple. Let me show you. So for the accounts for A Berhad, what happened is that we will actually have profit after tax, which is 20 million. But then we have a minority interest. The minority interest is actually here, the 20% that A Berhad does not own. So for A2 Berhad, my share is 8 million, not the 2 million. So I have to exclude the 2 million. And therefore, my final earnings is actually 18 million. So that is actually the case. All right. So that's where the minority interest came into play. So this is where the non-controlling interest is. So Shane, can you repeat the question? Which part of the ratio does he ask for? Is it the gearing
I
part
think
or
in
is it
fact
the
any
profit part?
formula that involve the equities, right?
Mhm.
Should we exclude minority interest? So that's Vincent's question.
Okay, so here, although the difference is quite minor, for net profit margin, you can just directly go use this. You can directly use this figure. I don't see an issue. But if you happen to use this also, the difference is not that great lah. But to be super accurate, you can actually just use this, which is profit after tax. But if you're looking at return on equity, use this. Okay, so that's for ratio number 2. Now, for gearing ratio, like this, in this case, take this, divide by this. All right, to be super accurate. But if you happen to use this, it doesn't differ that much, the results. But to be accurate, you can use this. Or use this lah. Total equity is actually a better figure to actually use. So that is actually the answer.
Thanks, Ian.
So back to you. Yep.
All right. The next question is by Kok Cheng. So what is the ideal gearing ratio for companies in different sector or industries?
That is actually where you have to actually do the calculation and find out lah. But without looking at industries, right, across all sectors, right, if you have anything below 20%, you should be quite okay lah.
All right. Thanks, Ian. What
Mhm.
do you think is the ideal debt to operation cash flow ratio?
Oh, the lower the ratio, the better lah. So like 1, 2, or 3 years will be quite okay.
All right. Thank you so much. The next question is by Kyung-che. Given the abundance of dependable platforms offering financial data for analysis, is there a need to dedicate valuable time to manual calculations like what you did? Isn't it more efficient to leverage these resources instead?
Yes and no lah. So sometimes you actually find out the ratios. I mean to say, okay lah, if you want to be that efficient, right? First, you can actually use the the tools lah, the screeners and whatnot. You screen out from 900, let's say Bursa Malaysia got 900 stocks. You screen out, let's say 30 lah. Then from the 30 stocks, you do them. Then you pick the ones that you want to actually look at, and then you start doing the manual calculation. So with that, the screener can actually help you to eliminate maybe the 95% that you don't want to invest. Then the remaining 5%, you slowly do the calculation lah. I think that would be much more efficient lah in that case.
Okay, thanks, Ian.
Mhm.
In one of the examples that you were showing just now, and it was loss-making, so the income statement actually show a very high administrative expenses. However, there are no notes
Mhm.
for it. So the question from Fahmi Ismail is, how can we find out more information about what happened in the increment in terms of administrative expenses?
There are a few ways to find out lah. Number one is actually at the chairman's statement or the CEO statement. Maybe if they actually give you a explanation, then very good lah. All right. So that is actually if they bother to give you any explanation. Lor. Maybe the explanation will come in the form of, oh, we are hiring more staff, or we are actually renting a new office, or we are this and that lah. So that one you need to actually read a little bit in order to get the context. Oh. So that's the first one. But the second one is that we don't look at 1 year, we look at 10 years. From there, you can actually see the whole perspective of the stock lah. Okay, so that is actually how, oh, okay, I get to see the whole big picture on how they run the whole business and all this kind of stuff lah. So that's why I always ask for 10 years lah, not 5 years.
Thanks, Ian. So the
Mhm.
next question is by Chan. How do we calculate the return of asset?
Oh, return on asset. Okay, let me just quickly share with you. Let's pick, okay lah, let's pick this lah, return on asset lah. So return on asset, you can actually just take the profit of the company. Let's say this, for example. No lah, I mean to say for return on asset and return on equity is different. Equity, you use this. Return on asset, you use this. You take this, profit after tax, and then you go here, you find total asset. You divide this figure times 100%, there you go. That is actually return on asset.
Okay, thanks, Ian. So Ian, if you want to choose the, pick good REITs to invest, which ratio should we focus on? So this is the question by Siu Kim.
Mhm. Okay, so for REITs, first one, and distributable income. So this one, you must actually get it right. It has to grow over the long term. Okay, so I won't say there's a specific ratio. You can calculate, you can take the distributable income and then you divide by revenue. That you will actually obtain something of equivalent to net profit margin already. So in that sense, you can actually apply whatever you learned today to assessing which of the REITs are actually worthy to be considered for your investment.
Thanks, Ian. The next question is by Po
Mhm.
Sheng. How useful are these ratios when it comes to evaluating a technology stock that always incurs losses and has high gearing in the early stages?
Okay lah. So I do not know. It depends on your investment objective lah. So let's say, for example, I'm a pilot and then I have all kinds of instrument in the cockpit, right? So if they say inside the cockpit, they have a lot of indicators, a lot of signals, and then everything keeps on telling me warning, 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 warning. Then as a pilot, do I still fly on and do not know what I will be hitting, right? So which means to say, it all depends on whether or not I mean to say, sometimes I use the analogy, investor is a bit like a pilot, and whether or not you trust these instruments. So if let's say you don't trust these instruments, then you decide then you will decide it very differently from a pilot that is trusting the instrument lah. But I guess if you want to actually, I'm not too sure why you want to actually invest in a technology stock that has been always incurring losses and very high gearing. I mean to say maybe who knows, out of these 10 stocks, maybe one will shoot up like crazy. If that is actually your game, then that's one way of looking at it lah. But from what I have actually observed, I do know that there are many technology stocks that are highly profitable, very low gearing, all this kind of stuff lah. So is there a need to actually take uh such a huge financial risk on this kind of stock when you have so many choices? You are actually, as an investor, we are quite spoiled with choices on so many other stocks that are highly profitable So is there a need to actually go with something which is not profitable and has a not so nice balance sheet and you have to keep on pumping blood into that stock all the time So that is actually the case lah.
Thanks, Ian, for sharing your view.
Mm-hmm.
The next question is asked by Kelly Yong.
Mm-hmm.
When you want to calculate the debt to operating cash flow ratio, do we just take the total NCL disclosed in the annual report, like what you demonstrated earlier, or should we exclude deferred tax liabilities, derivative liabilities, and those non-cash items?
Okay, there are two ways. For me, I'm a bit more detailed, so I will exclude. But if you want fast, you just want like a quick like snap, all right? You just want a quick snap, then you can just take the non-current liability. But if you want to be a bit more thorough, I will exclude lah.
All right. Thanks so much, Ian.
Mhm.
The next question is asked by Eugene.
Mhm.
What do you think about return of invested capital, especially adjusted return of investment capital, ROIC?
Mhm. Yep. Oh, I think it's a good ratio. All right. It's just that it's more, if you want to calculate it, it's more work. You need to actually input the time to actually calculate what is the adjusted figure. I think it's worth it. And then what is the invested capital? You can also do that. And then from there, uh, you kind of like, from there you will find out the return on invested capital. So whatever formula you use, don't use it for 1 year, use it for 10 years. Because whether you use return on equity, return on capital employed, return on invested capital, return on asset, return on whatever all right? Whatever you put on it, do it for 10 years, find the pattern. From there, you get a rough picture already. So if you want to use that ratio, return on invested capital, you can actually do that No issues
All right, thanks, Ian. So if Lin would like to ask, if the ratio for the company is showing not a good sign,
Yeah.
right?
Mm.
How many years should we let it to go on before we should decide to sell off?
Oh, this one is a case by case. This one is a case by case stuff all right? It's very difficult to say. So let's say you happen to find a stock and we have to actually understand the business nature of the stock, all right? And then we have to understand what are the challenges that it is facing through So let's say, for example, if let's say there's no justification, no whatsoever reason, the business is just bad then I say even 1 or 2 years you can actually let it go All right, so that's actually the case All right. However, if you're looking at, let's say, for example, all right, today something happened to the glove industry, right? Wow, a lot of things actually happened. Okay, so like I kind of like know that, all right, it is actually making a loss. And that loss is simply because I mean to say the glove industry is operating in very abnormal conditions lah. When it was making so much money, it's already abnormal. When it's actually losing so much money, when it's making small losses, it's also not exactly normal business condition. So in that sense, I think it was forgivable at that time. So we have to actually look at the industry, the business, and then from there we see. But if let's say lah, the case is that you buy a stock and then there's no apparent reason of why these things happen, then you may want to consider an exit on that stock lah. You may want to actually swap it for a stock that has all the fine looking ratios lah.
All right, thanks for sharing your perspective. Iqbal would like to ask, where can we get operating cash flow figure?
Oh, statement of cash flow. So it's actually at the final line.
All right. So Cockchain would like to ask, is it a red flag for companies with very high and increasing trade receivables?
Yes. That's a taboo. So you cannot have. So there are companies, right, where sales is rising, profits are increasing, trade receivable is actually on the rise, and there's no cash. Cash is always flowing out for the past 5-10 years. Red flag. Even if it's not a red flag, I will still avoid it because chances are that's a red flag.
All right.
I won't name any stocks here, but then there are some stocks that are memang like that, but that's a red flag.
All right. Eugene Wong would like to ask, do you have any other book recommendation besides 100 Beggars, right? It can be any good book on fundamental or psychology.
Yes, that's a good question. Like that question a lot. So, I guess it's actually it depends on what you want to read. Like Buffettology, I suppose you have read it. So that is actually a good book that I would personally recommend. So Buffettology is actually one. The others, for Bursa Malaysia, I guess there's a book on Once Upon a Time in Bursa or something like that. You can actually grab that also. Quite a good read. And well, anything that is actually related lah. But I guess still I guess Buffettology would be a good read lah, or anything written about Warren Buffett. But that one is quite heavy reading already lah. So I guess that one is actually quite recommended for the time being lah. But of course, I mean, lately, I mean to say, I went to Singapore and I grabbed a copy of, but that one is more like autobiography lah. I got it here, so it's strictly business. Not too sure whether you guys found this book. It's actually a story by Kwek Leng Beng. So this guy, I mean to say, for Malaysians, we know Hong Leong Group, right? Kwek Leng Chan, Hong Leong Group. So this is the cousin in Singapore. So although it's an autobiography, but it is still very highly relatable when it comes to, I find it to be very highly relatable when it comes to value investing lah. Simply because he uses, if you can see his style of, he's a real estate guy, but the way he buys his hotels and all this kind of stuff is very much value investing lah. So you can actually pick up a copy of that autobiography and read it yourself lah. I enjoy reading it.
All right, thanks for the recommendation, Ian. So we have run out of
Yep.
time for doing this Q&A. So thank you so much, everybody, for joining us in this engaging question and answer, even though we are not able to address every questions on the panel. All right, so ladies and gentlemen, you just heard from the co-founder of DividendVault, Mr. Ian Tai. Thank you so much, Ian, for doing this segment for us.
Hey, thank you so much, Shane. See you guys. Bye-bye.